Okay, we are going to go ahead and get started. Hello, everyone. Thank you so much for joining the call. We're really excited to get started with part one of our four-part wealth building series. Today's presentation is the language of finance. Now, before we get started, I would like to cover a few small housekeeping items. First off, just to note, we have allotted 1 hour total, but the presentation itself should only take about 40 minutes. That'll give us about 20 minutes at the end to answer any questions that you may have. On that note, I would like to direct your attention to your toolbar. Just so you can locate, there is a questions feature that is in there that you can use to submit your questions along the way. So as they come up, feel free to send them in and we will address them at the end. Today's presentation is being recorded, and we'll make sure that it's available for anyone to rewatch or send to a friend in the future. It'll be available on our website, Apriem.com. Lastly, I would like to note that there will be a survey that pops up at the end of the webinar today. We would really love to get your feedback. We are constantly trying to find ways to improve and bring you better content all of the time. We do go through and read those surveys, and we have actually made a lot of updates and changes based on the comments that we've received. So now that we have that out of the way, I'd like to go ahead and introduce our speakers. First off, my name is Josh Garland. I'll be today's moderator. I'm one of the financial advisors here at Apriem, and I joined the team just over 2 years ago. But I got my start in the industry back in 2009. I became a chartered financial consultant in 2013. And my area of specialization is really on the analysis and review of existing annuity policies, along with retirement income generation. I'm joined by Christopher Whitaker and Megan Schwab. Chris is our lead financial planner here at Apriem. He's both a certified financial planner and an accredited investment fiduciary. Chris obtained his bachelor's degree from Point Loma University in San Diego, California, and advanced credentials from Boston Institute of Finance. Before coming to Apriem, Chris worked at a high net worth planning firm where he was trained in each of the financial planning domains. Chris is married with 2 small children who happily take up all of his free time. At his side, we have Megan Schwab, who is an associate financial planner for Apriem Advisors. She graduated from Biola University in 2018 with a BS in accounting. Megan got her start in the industry here at Apriem as an intern in 2018 and officially joined the team in January of this year. We're very blessed to have both of them here on the team. And Chris, I will go ahead and hand it over to you to get us started.
Thank you, Josh, for the kind introduction. So thank you, everyone, for joining us today. Again, there are at least 4 generations on this call with us, and so I'm really honored to be presenting to such a wide group of families and ages of attendees. And I promise there's going to be something in this presentation for everyone, but also keep in mind that this series will get more advanced as we go along. You can see on the screen this is a 4-part series. Again, we're going to be doing the language of finance today. And so today's main goal is to help everyone get comfortable with the language of finance and definitions of important topics. And it's going to lay a solid foundation as we move throughout the rest of the series. So for those of you who don't know Apriem as well yet, our firm really prides itself on helping entire families get on the same page with their finances. And like Josh said, as a parent myself, this concept really hits home with me. And I think about this topic quite a bit, how to make sure the hard-earned wealth that is generated is not squandered. It's also used in a productive way for the generations that come after me. And there are some, quite frankly, some very alarming statistics that Megan's going to cover in a second pertaining to how most families lose wealth as inheritance passes to future generations. And here at Apriem, we feel like we have an antidote to that problem. We found that by educating each generation and meeting them where they're at in life to be better stewards of wealth is such a powerful concept to protecting multi-generational wealth. So by first mentally understanding how wealth is built and maintained, that person is exponentially better prepared to receive wealth and without it ruining them or squandering it. And so we hope this entire series is a helpful tool to be used and shared with your families, regardless of the generation. And so with that being said, I'm going to pass it over to Megan to share some interesting stats with us.
Yes, so before we get into it, we think it's really important to go over the why behind why we're doing this webinar. And as you can see, there are some pretty alarming statistics on the screen. 90% of wealth is lost by the 3rd generation. 48% of Americans have less than $10,000 saved for retirement. And this one's very alarming. Bankruptcy rates soar for lottery winners 3 to 5 years after they've won. And 27% of adults would need to borrow or sell something to pay for an unexpected expense of $400. So this just really hits Chris's point home about how not just having money is what's important, but having the knowledge of knowing what to do with it. And our goal throughout this webinar and even as a firm is to change those statistics so they're more positive in showing that people do know what they're doing with their wealth, and they know how to educate their children or even their parents to be successful with the wealth that they do have.
All right, thank you, Megan. And so with that, we're going to jump into part one here, language of finance. Okay, so finance really does have its own language, but just like with most languages, if you understand the root words and phrases of that language, then it's much easier to build an understanding of that language as a whole. So with that in mind, we're going to start with 10 key words or big concepts that will serve as a great foundation as we move through this series. And before I click in there, you'll notice that there's two different definitions for things. One's going to be the book definition. The second one is going to be a real-world applicable definition to how the best wealth builders in history think about that term. So let's jump in here. Okay, so big picture concepts. So to kick us off, I wanted to spend some time going over something that seems very simple. You know, I think if you ask 10 different people, you probably get different answers. And don't worry, I'm going to zoom in here. I know the writing's really small for now. So let's jump into the first one here, which is money. Okay, so if you were to ask the definition, you'd probably get 10 different answers. And it's especially interesting if you ask a young kid to define what money is. I encourage you to do that. A book defines it as a medium of exchange of a unit or commodity, right? And now I want to take it one step further, though, and take it a couple layers deeper. So for building and maintaining wealth, I'd like for us to think about money for our series as being a medium of exchange for our most valuable resource, which is our time. And so a section of the people listening to this webinar are already retired. Those people have already successfully stored enough of their previous time into various financial assets to where they can now live off of that stored time and spend their present time as they see fit, right? So once you have this lens for financial transactions, everything else becomes much clearer on how the best wealth creators in history have leveraged some of their own time, but also other people's time. So for example, a textbook says when you buy a share of a stock, you buy a piece of a business. While that's true, if we take that a couple layers deeper, if you think about it, what you're really buying is the time of thousands or perhaps hundreds of thousands of people working on those products, on that marketing, et cetera, for that business, for that stock. So if you store enough of your time in productive assets, you'll eventually reach a tipping point to where you can spend your time doing what you please, aka retirement or financial freedom. I'm going a little bit deeper on such a simple word because you'll see how we go through this series how important it is to think in these terms. Because if it's framed as, how can I be the most efficient with my time and the value I'm producing, that also is going to be extended to all of your investments and also any money-related decision. So I'm going to pass it over to Megan now for our next word.
Okay, thank you, Chris. So our next word is asset. And a book would tell you that it's an item that a person owns that has financial value. So the example likely following this book definition would be the equity you have in a home. And the investor would take that one step further and say it's actually something that puts money back in your pocket. So they would look at that same home and turn it into a rental property. And it's an asset to them because they're making a profit. They're collecting rent on that home, on that same home that the book is defining.
And I'm going to take the other side of that for our next word. We're going to take the other side of the coin, which is liability. So in other words, money that a person or entity owes someone else, or debt. But in reality, I'm going to, again, go one layer deeper where the investor definition is anything that costs you more than it earns. So if we put these two together, so let's just do an example of a car. Traditionally speaking, a textbook would say that's an asset, right? But an investor or a wealth builder doesn't think of a car as an asset. They would think of it more as a liability, because even if there's no loan, let's just say that is a completely paid off car. you still have taxes, insurance, registration, etc. on that car. So there are costs, or it's costing you more than it's earning. Now, productive people, though, can also flip it, though. So Uber is a classic example of maybe turning that liability into an asset. If you're using it for a business purpose, maybe the cash flows that you're generating from that outweigh the cost. Therefore, it would be an asset in our definition. And so that'll be important, as we go through the series here. All right.
All right, and next is net worth. So the book definition would take the total value of all your assets minus the total amount of your debts or liabilities. And an investor would actually take that net worth total and divide it into subcategories. And I actually had a light bulb moment about this term when I was an intern with Apriem, and it was described to me in this analogy. So two people with a net worth of $1 million. However, one person has a $500,000 home and $500,000 in cash. The other person just has the $1 million home. Which would you choose? And it just really shows how someone can have the same amount of net worth as another, but one has it better diversified and is set up for success in that way.
Hey, Josh, would you rather have $1 million in a Roth or a traditional IRA?
Well, I guess it would depend on what my tax bracket is today.
Okay, I guess that's what I get for asking an advisor. There you go. Yeah. The answer is it depends. All right. I'm going to take on capital gains here. So book definition, the profit that results from selling an asset is grown in value. Real simple, you buy a stock or some kind of capital asset for $100. You sell that for $120 once it's grown. There's a $20 difference there. That would be taxed as a capital gain. But investors think of capital gains basically as a more favorable tax rate, though, or something that can be avoided entirely. And so, for example, there's a lot of famous publicly traded CEOs that take $1 salary, so they have $1 of ordinary income, but then they're living off of stock sales through stock options or stock grants, et cetera. And they're really, they're going to have a more favorable tax rate. They could sell millions of dollars of stock, but have a lower effective tax rate than someone who just earns a comfortable living and then is paying ordinary income tax. Another thing that can be thought of here is avoiding it entirely. So if you have an asset that's valuable, maybe you can take a tax-free loan against that asset as opposed to selling something that's highly appreciated. There's a lot of little nuances there, but that's more the investor side of the way to think about capital gains. All right.
Okay, and amortization. So this is the process by which the amount due on a loan is reduced over time. So take an auto loan, for example. Typically, the beginning portions of those payments go towards interest. And eventually, as you're paying off more of the loan, the majority of the payment will then go towards principal. So an investor definition, they think of this as I can be the one collecting interest, or the interest rate is a hurdle rate when it comes to my investments. And a hurdle rate is just the minimum required rate of return needed on your investment. So for example, if you're paying off a 3% loan, you're giving up the opportunity to make more than 3% on those same dollars, say in a brokerage account or something of that nature.
Mm-hmm. All right. And I'm going to pick on a big topic here, inflation and deflation. So a book definition would be an increase or decrease in price or a fall in, or rise in purchasing power of money. And so the investor definition here, I'm going to simplify this for everybody because it gets talked about, especially right now in the news a lot. The simple way to think about inflation and deflation is my dollar purchases less or it purchases more. So we're based in Southern California. Megan, what was the median home value in Orange County in 1975?
It was only $34,000.
Okay, $34,000. And now in 2020, what is the median Orange County home value?
No, $800,000.
$800,000. Okay. First of all, wow. Second of all, that is a great example of inflation. So, and by the way, it's not like that $800,000 home has some fancy new tech to it. It's pretty much similar building materials, maybe some upgraded text piping or something like that, but it's pretty much the same thing. And yet it's $800,000 versus $30,000. That's a classic example of asset price inflation. Classic example of deflation, flat screen TVs, right? They used to be incredibly expensive, as much as, many thousands of dollars. But I can attest Black Friday just passed, and there's a 70-inch Samsung 4K HD for $475. So not only has the price dramatically come down, but it's actually a better product on top of that, right? And so inflation and deflation, it depends on what asset you're looking at. And just to one more layer, because it's in the news a lot right now, maybe the Fed's trying to induce inflation. They're talking about one specific kind of inflation, which is CPI, or a basket of goods. That doesn't necessarily mean that there's no inflation going on around you. You could look at money supply. Money supply has increased by more than 20% in 1 year this year. You could look at, again, the housing example we gave, right? So it depends on what you're measuring. What is your measuring stick if it's inflating or deflating? But there's the investor definition for you. All right, Megan?
Okay, and next we have time value of money. So this is the thought that money received or earned now is worth more than money earned in the future. And so investors think of this in compounding exponential terms, not linearly, which is a very important difference when it comes to this concept. And now we're going to have a little bit of an interactive time. So I'm going to ask you a question, and you go ahead and try to put your best answer in the chat box, and we'll see if anyone can come up with the right answer. So the question is, say you have a magic penny. How much is that magic penny worth if it's doubled every day for 31 days?
So 1 cent, 2 cents, 4 cents, 8 cents, 31 days in a row. Everyone type in your guesses.
So you can answer those in the chat box, and we will give everyone about 30 seconds to a minute to put in whatever you think your guess may be.
Some guesses coming in.
All right, I think that's probably about enough time. Do you guys, oh, wait, we have hang on, let's see. Okay, I have $1 million.
There you go.
$1 million.
What's the answer, Megan?
The answer...
More than $1 million.
That person is correct. It's actually a little over $10 million can be made if you double a penny once a day for 31 days. And to hit that point home even further, when you look at the chart showing that doubling every day, after day 20, the value of that penny would only be about $5,000. So there's value in being patient with your investments. And in this penny example, watching it double just at 11 days makes a huge, huge difference.
Yeah. Good reminder that our brains are designed to think linearly, not exponentially. It's very difficult.
There was one answer that I really enjoyed, and that was more than we all have combined.
All right. And then the volatility is the next one I'm going to talk about. So measure of how quickly the price of something can change over time is generally seen as a risk. But the investor definition, now I'm not going to spend a whole lot of time on this one because there is a 4-part series that our investment team with Ben, our CIO, put together that is excellent. Over 4 hours of content that hits on these kinds of topics and how volatility can really be your friend. But I wanted to drive this point home for anyone watching who hasn't seen that. That really one person's perceived risk can be another person's opportunity. So volatility can be your friend. It's the essence of buying low. And for whatever reason in markets, especially in financial assets, people tend to run away from a sale, when in reality it could actually be an incredible opportunity. All right.
Okay, and last but not least, yield. So yield is the earnings of an investment expressed as a percentage. And an investor would say it's a passive salary that you no longer have to trade in your time for. So for example, AT&T pays a 7.2% yield. So if you saved $1 million in AT&T, you'd receive a dividend or salary of $72,000 a year. So thinking of these yields or dividends in terms of salary is a really good way to normalize asset classes and what you can make on your investments.
I remember the first time I heard about a dividend. I think I was a young teenager, and it was just mind-blowing to me that, oh, okay, wait, so you're telling me that if I own enough of these things that I could just do whatever I want to do with my time and just collect passive checks? And it was just such a powerful concept.
I think for me it was when someone described it as, imagine the stock being similar to owning a piece of property, right? Yeah. And then if you had that piece of property and had a renter inside that paid you rent, and the rent itself kind of representing similar to what the dividend is, right? So the value of the property would still fluctuate and go up and down, but you would also be collecting that monthly rent,
Yep.
That theoretically kind of goes up over the course of time.
Yep. Yeah, absolutely. And those of you who are already retired and are clients, you understand how we use yield in your portfolios to generate some of your income. All right. Okay. So the next topic here is how the economic machine works, and I'm really excited because Megan does a great job with this topic. So I'm going to have Megan walk us through how our economy actually works. So, and I think this is important because not only understanding of this concept opens your eyes to kind of what's going on around you, but it will help you make much better decisions for your own finances because it's the system that we're all forced to adopt. And so Megan's going to help us to understand the underlying rules and mechanisms of the financial game that we're forced to play with our economy.
Yes. So what you see on the screen is a quote from Ray Dalio. He's a very successful investor, and he does a really good job of explaining how the economy works in very simple terms. This is a topic that we could talk about for hours, so we'll just be going over the very basics. But there's so much that goes into it. And something that he says that I think is a great way of explaining it is the economy is made up of a few simple parts and a lot of simple transactions that are repeated over and over again. So going to the basics, a transaction is when a buyer exchanges money or credit with a seller for goods, services, or financial assets. So every time we buy something, we make a transaction. And this is really the building block of the economic machine. And if we can understand transactions, we can understand the whole economy. So if we go and talk about markets, an economy consists of all transactions in all its markets. So a market really just consists of all the buyers and sellers making transactions for the same thing, whether that's wheat or cars, oil, or even stocks. Those are all their own markets that work like a single gear in this bigger, well-oiled machine. So the biggest buyer and seller in a market is the government. You have the central government that collects taxes and spends money, and the central bank that controls the amount of money and credit in the economy by influencing interest rates and printing new money. And they're a very important player in the flow of credit. So credit is the most important part of the economy and probably the least understood because it's the biggest and most volatile. And for every $1 there is at least $20 of credit outstanding. And as soon as credit is created, it turns into debt, which is really important when we go into cycles in a little bit. So when a borrower receives credit, they're able to increase spending, which drives the economy. And an increased income allows for increased borrowing, which allows for increased spending, and it creates a pattern, which we call cycles. So because we borrow, we have cycles, and it's just due to human nature and the way that credit works. So every time I have more income, it may make me want to spend a little bit more. I feel comfortable extending my credit so that I can purchase something that I want. And you can see here the graph at the bottom. The straight line is the productivity line. You see a big curve, which represents the long-term debt cycle, and then those small wavy curves indicate the short-term debt cycle. So the short-term debt cycle, it goes through about every 5 to 8 years, and that's just an average. It changes, but that is the average. And during that short-term debt cycle, when credit is available, we see an economic expansion. So that's when the curve starts to go up. And when credit isn't available, we start to see a recession, which is when the curve starts to go down. And then that takes us into the long-term debt cycle. So as long as income continues to rise, debt remains manageable and asset prices soar. But over the decades, debt increases, causing larger debt repayments, which result in reduced spending, and eventually the borrower isn't able to pay that debt back. And that's when you see that big dip and that big curve. And those long-term debt cycles typically happen every 75 to 100 years. Again, it depends, and that it's not always that long or that short, but that is about the average cycle.
I think there's some fun correlation here to what Chris was talking about earlier when he gave us the definition of money, right? And money essentially being it's really a unit of store or a store of time, right? And we can look at the graph that's down here, and there's the straight line, that productivity line, right, which essentially is time. And when we use credit, we're borrowing money from the future. We're borrowing future earnings, right? Future time that we would have put in to earn those dollars, and we're taking them and we're bringing them into today, right? And so if you took a line like that and you pulled it shorter into today, so I could spend more of it, have more of it now, it's going to create that kind of a ripple in general, right? And so I have more now, I can spend more now, but in doing so, I'm forcing myself to spend less later, right? And hence the dips, right? So I can spend more now, up. I have to spend less later. It's inevitable at a certain point in time. I borrowed that from the future. Now I have to slow down later and spend less later.
Okay, so for this next one, we're going to do introduction of asset classes, and I'm going to take this one here. And so let's go through this. Okay, so once again, we have the whole series on stocks and bonds that our investment team put together. So I'm going to be really light on stocks and bonds for this specific video. All right, so just real simple, a stock is a security that represents ownership in a fraction of a business. Plain and simple. There's lots of different flavors of that, but you are buying a piece of a business. And a bond, just think of that like a reverse loan. So all a bond is you loaning your money, collecting interest in the form of yield, and then hopefully getting your principal back. And if you're loaning that to government, you have municipal bonds or corporate bonds, et cetera, right? So that's really stocks and bonds in a very brief nutshell. And then we have real estate. So real estate, I put in its own category because it's obviously very popular. And so for our purposes, we're just going to divide this into three. There are obviously many subsectors of real estate. For our purposes, a single family, right? That's one's pretty intuitive. Most people live in a single family home that are listening to this. Then you have multifamily. Multifamily is basically anywhere usually defined as a duplex to a quadplex, so 2 to 4 units. As you approach over 4 units, the financing and the rules change around it, so it kind of moves beyond multifamily and becomes commercial. And then commercial can be anything from bigger complexes, obviously storage units, business parks, the building I'm presenting from where our headquarters is in Irvine, et cetera, et cetera. And obviously those are valuable pieces to own. And we'll talk more about that in the future. And then there's miscellaneous alternatives. And so I'm just going to touch on some of these. So one we have is cryptocurrency. That's in the news a lot right now. I'm just going to give you a couple of pointers here so you'll know more than the average person just by knowing a couple of things here. There are 3 major kinds. There's store of value, there's quick payments, and then there's decentralized applications. So for example, Bitcoin is probably one of the most famous ones, and it's a store of value crypto. Then there's decentralized applications, which is more like Ethereum. And that's a whole world that's kind of building up around us. We can obviously, feel free to put them in the Q&A, or we can talk afterwards one-on-one. Then we have commodities. Obviously, some of these have been around for thousands of years. So commodities are raw material that can be bought and sold. Gold, silver, oil are the most common examples. Usually values derived from being somewhat scarce or used in some kind of industrial purpose. Then you have land. Land's an interesting one where it's basically there's lots of different ways to monetize it. I have extended family and immediate family that monetize land in the form of agriculture. But you could also generate income by things like billboards and advertising on your land, or cell towers and other things like that. So just a couple of interesting and common alternatives that we see in people's plans. I'll touch on those. All right, and then now we're going to get into how to actually invest in an asset class. We purposely put a kind of a confusing picture there because it can certainly feel as confusing as that blackboard looks, especially when you're first getting started. And I often get questions that link together types of different topics. So for example, maybe I get a question like, should I invest in my 401k or an ETF? When in reality, those are very different things. And so what we're going to do is we're just going to kind of lay the foundation here and divide up some of those topics into their own categories. I'm going to have Megan kick us off with some common types of accounts.
Yes, so these accounts are really the shell, and that's what holds the stocks or bonds or funds, which some of that Chris has already talked about. And again, there are so many different types of accounts, but we thought these were some of the most common, and some we come across every single day, so we thought they'd be good to talk about. And before I define them, I think it's important to note that most of these accounts listed here have a lot of rules and nuances that we won't necessarily go into here, but it's something to keep in mind when we talk about these. So the first is the Individual Retirement Account, or IRA. And this is a type of retirement plan that's offered by most banking institutions. You could actually go open up one yourself and start investing for your retirement in that way. And a lot of people tend to use it in conjunction with a 401k, which is a plan offered by your employer. So with the 401k, the employer sponsors that plan for you, and there's usually a specific set of funds or maybe even stocks that you can choose from to invest in. But we've seen people use that with the IRA to really capitalize on saving for their retirement and giving themselves, the greatest chance of success possible in whatever way that looks to them. And then there's a 403b, which is very similar to a 401k, but it's a retirement plan meant for public school employees and some 501c3 organizations. And Josh has a really good analogy of how to look at these different retirement accounts.
Yeah, I've always enjoyed using the analogy of thinking of these different accounts as kind of like uniforms, right? So, if you imagine, you have a fireman, you have a police officer, you have a paramedic, right? And all of us can look at any of those folks and identify what they do, right? And while there's individual people that all probably have their own unique characteristics and traits inside of those uniforms, when we see them, we have a pretty quick understanding of, what is their purpose. One of them is here to protect us from crime, where the other might be there to protect us from a fire, right? And so we can all very quickly identify what it is that they do. And so when we look at these different types of retirement accounts, or even non-retirement accounts, but 401k, 403b, IRA, 457 plans, pensions, that really helps. It helps us as advisors identify what those accounts do and how to think of what they do. But even more importantly, it tells the IRS on how to treat those accounts and what to expect from the transactions that occur both in and outside of those accounts. So anyway, I like that analogy.
Yeah, I think it's great. Yep.
That's great. And a Roth IRA, this is similar to an IRA, except that it's a retirement account that houses after-tax dollars, which allows for tax-free withdrawals at retirement. So for example, I get my paycheck every month, and say I take $100 from that paycheck after I've received it, and I put it into my Roth IRA. That means I've already paid taxes on that $100, and it's going to grow tax-free until I need to take it out for retirement. And one of the really cool things about Roth IRAs is they assume that you're going to have a higher tax bracket or be in a higher tax bracket once you hit that retirement age. So it gives you a lot of opportunity to save a lot of money on taxes depending on your situation. And finally, we have the taxable brokerage account. So in the beginning, I mentioned that most of the accounts listed on the screen have some special rules or restrictions, like you can't take the funds out until a certain age, things of that nature. But the taxable brokerage doesn't restrict when you can use your funds. You can take them out whenever you want, and you can use them however you want. So Chris always likes to describe them as fancy savings accounts. They just give you the opportunity to learn to earn more on your investments and on your savings.
Obviously, as you can see, there's a lot of nuance. There's a lot of accounts that we didn't mention, and those of you who've gone through financial planning, that there's different creative ways to use all these kinds of accounts. And anyone who hasn't yet, please take us up on that. we'd love to help you figure out which of these accounts actually make sense for your personal situation. All right. So now that kind of Megan laid out the types of accounts, I'm going to talk a little bit about things that you can put inside those accounts. And that's really how I would kind of try to think about ETFs, mutual funds, and individual securities. Now, ETFs and mutual funds, there are some nuances there, but for most people, you can kind of put them in the same basket almost. Really, just think of an ETF and mutual fund. Both of them are great at really thinking about them as a basket of a stock or a basket of bonds, et cetera. So individual security would be going out and buying actual individual shares of Apple, Amazon, Google, et cetera, right? An individual stock or an individual bond, perhaps. Whereas an ETF, you're buying a share of a fund that owns maybe hundreds of stocks underneath that. So it's traditionally been a cheap way to get diversification as well. And so that's just kind of a simple way to think of those three things. And again, we'll go deeper as we go throughout this series. And then just wanted to really briefly touch on structured partnerships, because again, for those of you who are less experienced investors, some of these might be new terms, but really the point of this slide is not to necessarily dig into the details between LLCs or LPs or REITs, but really just to introduce the concept of the fact that people pool their money to go after different kinds of investments. So an example would be a REIT, or a real estate investment trust, where instead of one investor having to come up with, say, $20 million to buy a big building, it could have a ton of different investors putting in smaller amounts of money and then combining and having that REIT or that real estate investment trust own that building, and then you own a piece of that building. Almost like a company dividing up into shares. And you have limited partnerships and LLCs, right, which are a slightly different shade of that, but can be invested in a more broad array of categories. And the reason I bring some of these up too, again, as we get deeper into the series and get more advanced, you'll notice that there are investors that will be analyzing that have used some of these structures incredibly well to generate mass amounts of wealth. So that is our key presentation there. So I guess we're going to Q&A. And so it is question time.
Okay.
I'm hoping there's a lot of side-splitting laughter at our corny joke.
Okay, so we got a question early on. How do you reconcile market value versus book value? Example, ExxonMobil wrote down the value of their assets, yet the stock price rose.
Interesting. Okay. That is that's a very deep question. I'll take a first crack at something, how something can write down but then still get caught up in things, or increase in value. I'll speak generally first. So how markets work right now, they are incredibly passive based. So I'll take it from this angle first. So when someone buys a slice of an index fund, like SCHX, for example, or something like the S&P 500, you are putting money into all those companies on that list. So if the market is heavily passive and there are more inflows coming into those index funds, which I think there's a study by JP Morgan that says more than half the market's passive, give or take. You'd have to ask Ben, our CIO, to clarify that for you. But anyways, there's more fund inflows, then stock prices can be swept up in that tide, that almost like an oceanic tide rising. As more liquidity comes in the system, stock prices will go up. That's one answer. Another reason would be, I don't know, you want to take another example of that, Josh? Yeah. Okay, I'll take another. How about asset price distortion in general? So, for example, if interest rates plummet, which we're at very low interest rates, then financial assets become more valuable in general. And so we're going to get into some deep waters here. But if you think about low interest rates, or risk-free rate is what I'm going to use. If risk-free rates are next to nothing, then the alternative to investing in stocks is not as attractive. So, for example, the 2000 tech wreck, you had incredibly high valuations, but you also had a risk-free rate somewhere around 5 or 6%. So you had a higher risk-free rate, whereas now you have closer to zero. So that also props up asset prices. I hope that helps. And we can go deeper if you want, but more one-on-one.
So let's see here. The next question that I do see on the list here is, I have access to a 401k and a Roth 401k.
Okay.
Which should I use?
So I'm going to answer from a broad perspective first, but of course I would encourage this person to reach out and we can go one-on-one to answer specifically for you. But in general, for anyone who's debating between Roth or traditional 401k or Roth 401k, I'll give you, just like we did before, the book definition, and then we'll go real world. So a book definition would describe to you a term called tax neutrality. And tax neutrality is the concept where if you have two piles of money, one you get taxed beforehand and you put it in like a Roth. The other, it goes in pre-tax, you're not taxed yet, it's like a 401k, and then it grows tax deferred. If you have the same investments compounding at the same rate, even though they're different dollar amounts, and then you have the same tax rate at the end of that, you'll end up with the exact same amount of dollars, and that's tax neutrality. So that's the book definition. A simple real-world way to answer this question would be, is your tax rate higher now, or is it going to be higher later? That's how you think of that question. And it's impossible to know for sure, but you can make educated guesses on if that's going to be higher or lower based on a solid financial plan.
I do want to point out that when it comes to a Roth 401k, especially in the case that there is some sort of matching that goes along with it, I think it's a fantastic program because what happens is all the money that you personally contribute out of your paycheck into that Roth 401k, that will stay in the Roth side, right? And it will be tax-free in the future. However, any matching contributions that go in actually go in as a pre-tax contribution. So it's treated like a traditional 401k. And so what will happen is at the end of the road, when you get to retirement, you'll actually have some dollars that are taxable dollars, and you'll have other dollars that are Roth dollars that are where everything is tax-free. And it'll actually give you the ability to kind of to pick and choose along the way as to which accounts will be more beneficial for you to take withdrawals from. Because like you said, we don't actually know what our tax rate environment will be when we get to retirement. Mm-hmm. I think a lot of argument would go into it's going to be higher, just due to national debt, and how are we going to pay for this, right? But we really don't know. It could be exactly the same, in which case it would, like you said, would not have made a difference. Mm-hmm. Myself. So another great question here. This might be kind of fun for you guys. How have you guys chosen to build your wealth personally? In other words, how have you chosen to invest and plan for the future?
Megan, you want to start?
Sure. I'm pretty young in my investing life, so it's been really fun to explore all the different options. But right now I'm starting really basic, just exposing myself to the market, being invested in stocks. And again, going back to that portfolio construction series, the investment team here has done a really great job of explaining why those are so important, and really how to look at a stock and see how it's valuable and determine its value. So that's where I'm starting out right now, is just going directly into the stocks themselves. And one piece of advice I've heard and really taken to heart is, start as soon as you can, because it goes back to that compound interest. The sooner you start, you'll see, exponentially great returns in the future. So that's something I've been really practicing as I get started in this area.
I think for me, it depends on who I'm talking to on how I'm going to answer that question. I mean, if you're talking to somebody that's younger, that's just getting started, I mean, the answer is the sooner the better. I mean, the compounding interest is huge. My young kids, I'm forcing them to put money aside right now because they don't realize how powerful compound interest can be over the long term. But I mean, you're going to hit main points with somebody that's younger, just getting started. It's live on a budget. Right? Like learn what a budget actually is and how to manage a budget, pay down debt or don't get into any debt to begin with until you really understand the difference between good and bad debt. And then start saving. I mean, start talking money aside, start with an emergency fund, and then from there, continue to save and grow and invest. And I mean, in the beginning, it's one of those, invest in anything, just put it aside. I think that mutual funds or ETFs are a great place for somebody who's young and just getting started, just to put money aside and maybe put it in something you're interested in. I got my daughter interested by getting her to invest in Disney stock, and I got my son interested by investing in a video game ETF. that this at least gets some kind of interest in, what's happening, and it allows me to have conversations with them and talk to them, when something exciting at Disney happens and it happens to do well for my daughter, and I share that with her and tell my son that she's beating him, or vice versa, But get started early and never stop learning. I think that education is big as well. And of course, if you have a retirement plan, if you have a 401k and there's a match, there's no reason to not at least be saving up to whatever that matching contribution would be.
Yeah, and I'll just finish it by saying I practice what I preach. So most of my wealth is being built in 401k from here at Apriem, and then IRAs on the outside that I build up as well over time. And then I have my primary residence. I also have Southern California real estate as well in my portfolio. And I do have some of those alternative assets as well outside of my retirement accounts. But most of my wealth is right here in the market with everyone else. So, yeah.
This is getting us to the end of our time today. So if there's any additional questions, please feel free to reach out and give us a call. And with that, I'd like to thank everybody for joining us, and keep an eye out for the next part of the 4-part series, which will be coming. We'll be sending an email out to everyone with registration information. So thank you so much, and we'll talk to you all soon.
Bye, everybody. Thank you.
Bye. Thank you.